accountants like, beat each other up to try to get to the fourth, right? Because everybody wants to go on the fourth, right? Nobody wants to go on Monday the second. So they want that 3 extra days. Right? But I'm only going to have a certain amount of slots. So it'll be interesting. We'll be taking bets on Sunday. See who can get there and who's going to win the slot. All right. So what are we doing tonight? We might actually be able to get out of here a little early today because the last class was like completely torture. Okay. Yeah, because they don't know how to calculate percentage changes when the EPSs are negative. They can't, and they didn't know how to calculate average annual compound growth rates either. So a lot of the analysis that we were doing, we couldn't do. We were set back because a lot of people didn't know how to export into Excel and do the calculations, or knew how to do the basic mathematics. So we'll walk through and we'll verify their numbers, maybe change them up a little bit, and then we'll run through the calculations. Okay. So does everybody have JP Morgan up there? Emergent? Does everybody have Emergent site? What's the JP Morgan's ticker? Yep. So will everybody look around and make sure that everybody, around you. And then if people don't know how to get to Emergent or how to get to JP Morgan, can you please show them how to do it? And then when I start asking questions on where to get the data, can you show them how to go get the data? So they're not, WeChatting and Facebooking and MySpacing, just basically zoning out on their, because they just don't know what's going on. So you guys need to teach them, get them up to speed really quickly. Yes, sir.
Are both the teams doing JP Morgan, or is there one?
No, everybody's doing JP Morgan. How many people don't have a team? That's a good question. Okay, how many people have one person in their team? Okay, how many people have 2 people in their team?
At least here today.
2 people, 3 people.
I
have 3.
So nobody has 2 people in the team? How many people have 3 people in their team? Got it. How many people have 4 people in their team? How many people have 2 people in their team?
We have 3.
We have 3.
How many people have 4 people in their team?
Right here, 4.
Okay, no, just the leaders.
Oh, the leaders.
Okay. Okay. So you have 4 in your team? Okay, are you with them? Okay. All right, so everybody's all teamed up. We got teams. You guys all like each other. You can hang with each other. Okay, cool. All right, so let's do this. So everybody go up to the JP Morgan page. All right, and then we're going to go through. You got to find me the data, and you guys got to make sure that everybody is following along. So you need to teach them. Okay, and we're going to verify the data. Okay, we're going to verify the data. We're going to verify the calculations that the last class did. Okay. So let's go through. So the first thing I need, we're going to be using, what's the ticker again?
GPM.
So the first step, and this is part of the oral exam too. So the first step in the valuation process, the way I like to do it, is to calculate the discount rate sensitivities. Okay? So I have to come up with discount rates to apply to the future cash flows. So what cash flow metric are we using? What cash flow metric are we using to value the stock? What cash flow metric? What cash flow metric? What cash flow metric are we using? Let's see, I only did it 4 times on the midterm. Now, what's the cash flow metric? Okay, you're going to be sitting in a room, okay, in a meeting with a bunch of people around the table, and they're going to be asking you questions. And if you can't answer the questions on basic finance, you're not going to be asked back to the meeting, okay? And then maybe in 10 or 15 years from now, you're going to be a managing director or division head of a company, or you might even be moving on into the CEO, COO, CFO, CEO, whatever, CIO position, and they're going to be talking about this stuff, and you're going to go, geez, I don't remember anything from Professor Sousa's class because yeah. That's the models that we're going to use to calculate the intrinsic value, but what cash flow metric are we going to use? You don't need to
Operating cash flow?
What cash flow metric are we gonna use to value the stocks? Just yell it.
Oh, discounted cash flow?
Now, what's the cash flow metric that we're gonna use to value the stock?
EPS.
What?
EPS.
Does that sound right?
Yeah.
If we're gonna come up with stock price valuation, will we use earnings per share? Okay, half of you don't even know what I'm talking about. Would you use earnings per share as a cash flow metric to value the stock? Yeah, got it. And if if I'm not using EPS, what am I using? What's the other? Yeah, I'm gonna probably use EBITDA. And if I'm doing a REIT? If I'm valuing the stock of a REIT, what would I be using?
Net operating
I'd do that for real estate.
income.
So what's the cash flow metric? Yeah, FFO per share, got it. You guys should all know this, you just took the minute. Okay, unless you were copying off each other and looking at your phone when you were doing it. I caught a few people doing that. Okay. So we're gonna use earnings per share as the cash flow metric, all right? What else? I gotta do we have to determine the discount rate sensitivity. So what methodology would I use to come up with discount rates or expected returns? Now you could look at the board and that would be really easy, right? Because I already calculated it and I already put it up on the board. So why don't you guys just look up at the board and tell me what it is? So what are the three methodologies that I would use to determine the discount rates to be able to calculate the intrinsic values? I would use the CAPM, and what does that mean? What's CAPM? What's CAPM? What is CAPM? What's CAPM? Okay, do you have a computer in front of you?
Capital asset pricing model.
Got it. What is the capital asset pricing model? I mean, this is the way it's gonna be. You're gonna have a computer in front of you and somebody's gonna ask you a question and you're gonna sit there and expect them to tell you. They're not gonna tell you. You gotta look it up. Okay? And your generation can look this stuff up and give you the answer in less than a minute. I couldn't do it in 1990. I had to remember the stuff. Because there was no computers, there was no laptops or computers in front of me, especially in 1980. Okay. All right, so what's the method? Capital asset pricing model. What's the capital asset pricing model? How do you calculate it? How do you calculate it? Okay, can you look it up? Can you look it up on the PowerPoint slides? Can you look it up in the chapter presentations? Can you look it up online? Can you look up on the board? Can you look at your ankle where you tattooed it at the beginning of the semester when I asked you to memorize it in the pre-test? Because I told you you were going to have to memorize it.
It's the expected return of investment.
Okay, so the expected return, when you use the capital asset pricing model, what are you trying to calculate? I know you're trying to calculate the expected return on what? What are you trying to calculate? The expected return and the cost of what? What are you calculating? What does it give you? It gives you the expected return and the cost of what?
Systematic risk.
Nope, you're going to use the beta as the measure of systematic risk.
Assets.
You're going to calculate the expected return on what? The answer is not up here in my forehead because I'm not going to tell you. You need to figure it out and go get it. So can you look up the capital asset pricing model online and tell me what it's supposed to measure?
Return on the market.
You're going to use the return on the market in the calculation for the expected cost or the expected return on what?
Investment.
It's not on the investment. You're going to use the risk-free rate in the capital asset pricing model to calculate the expected return and the expected cost of what?
Risky securities.
That's a general term. I'm looking for something specific. So what does CAPM calculate? The expected return or the cost of
Return
what?
for assets.
On what?
For assets?
That you're far away.
Oh.
So what is it? What does it calculate? The expected return and the cost of what? Yeah.
Cost of capital?
What kind of capital?
Capital assets.
What's the capital? What capital? Is it debt or equity? It's equity. Got it. So you use the capital asset pricing model to estimate the expected return on the equity and the cost of the equity. Okay, it depends on who you are. If you're an investor, you use CAPM to calculate the expected return on the equity if you're the investor. If you're the firm, you use CAPM to calculate the expected cost of the equity. Excellent. Okay. So how do I calculate the, give me again, how do I calculate the expected cost of the equity using CAPM? What's the equation?
Risk-free rate.
Risk-free rate, and what do we use as the risk-free rate? What do you use as the risk-free rate? What do you use as the risk-free rate? Are there any risk-free securities out there? No? Really? What kind of bonds? Government bonds, treasury securities, risk-free, got it. So what's the average holding period of a stock? Can you guess? I would be writing these down, this stuff down. It's really handy when you write this stuff down. So what's the average holding period for a stock?
3 weeks.
What?
3 weeks.
Really? So you're gonna reinvest your money every 3 weeks?
What is it, like 5 years?
Yeah, it's like 5 to 7. Exactly. So if I want to match the holding period of the stock to the maturity of the bond, what maturity would I use as the risk-free rate proxy? If the average holding period of the stock is 7 years, what risk-free security maturity would I use as the risk-free rate?
Treasury bond,
I would use treasury bonds with maturity.
10 years.
I would use the 10-year. I should probably use, if the average holding period is 7 years for a stock, I should probably use what?
7 years.
The 7 years, okay, excellent. This stuff is not hard, it's actually a lot of this is logical. But if I want to be conservative, what maturity would I use? The 10-year, got it. Can we look up the 10-year? Yeah, what's the 10-year right now? Trading it. This is the application portion of the class. I know some of you should have taken the other class from another professor and just did the theoretical stuff. But I'm trying to teach you actual application that you can use moving forward in your career. Okay? So, where's the 10-year treasury right now?
18.7.
18.7%. Really? So basically the government borrows at 18.7%.
1.88.
Yeah, it's like 1.88 or rounded up, what is it?
It's 1.89 rounded.
Yeah, or if you round that up, it's
2.
roughly 2%.
That's a lot.
Okay. And what's the theory? What's the model that you would use to estimate the nominal interest rate on the 10-year treasury? What model do you use to calculate the nominal interest rates? This equation is tattooed on your other ankle. It was in the pretest too, that I asked you to memorize. So how would you calculate, what's the model that you would use to estimate the nominal interest rate on the 10-year treasury?
Real interest rate plus inflation rate.
You know, or inflation,
Percent.
it's not inflation, it's inflation expectations. So if you take the real rate plus the inflation expectations to get the nominal interest rate, what equation did you use? The Fisher equation. Excellent. Got it. So where are we today in 2019? Are we in a recession?
No.
No. Are we in growth peak?
Yep.
Yep. What's next year?
2020.
2020. Are we going to be in a recession next year?
No.
Potentially.
Yes.
Well, what's next year? What's going on next year? Is what? How many times has there been a recession during an election year? Really?
Not usually because they like, depending on the president.
Do you think incumbents in Congress and in the executive branch wants to have a recession in the election year?
No.
So what are they going to probably try to get the Fed to do? Lower interest rates to stimulate the economy. Has the Fed done that?
Yes.
Exactly. So that it lowers the probability of a recession next year. What about incumbents? People in Congress, both houses, the Senate and the congressional districts. What do they like to do during election years?
Get reelected.
Get reelected, and how do they do that?
Spend a lot of money.
Exactly, appropriation for their local jurisdictions. So they're gonna increase appropriations to the local jurisdictions to increase their election, probability of elections. So what's the probability of a recession next year? Yeah. So is the economy gonna continue to grow?
Yes.
What's that gonna do to demand? Increase it, what's that gonna do to prices? Increase it, what does that do to inflation? Expectations? Increase, what does that do to interest rates? Okay, so where do you think the 10-year treasury is gonna be next year? It's probably gonna be higher. So tell me what it's gonna be, what do you think? Where is it now? 2%, where is it gonna be next year?
2.5?
2.5, anybody else?
3.
3, anybody else? What? You're gonna be sitting in these meetings, they're gonna be asking you questions, either in marketing or ops or digital media or whatever it is, they're gonna ask you questions. And you gotta be able to answer the questions. That's why you went to school. So you can learn this stuff so you can participate in the conversations. So you can be invited back to the meetings. So where do you think the 10-year treasury is gonna be yielding this time next year? I got 3, I got 2.5, I got 2.6. I got basically 25 people in the class. Is that a large enough sample to get a normal distribution? If I survey everybody and basically plot it into a histogram, would it be a normal distribution? 25 samples? Yeah. Yeah. Yeah, it's gonna be close. And can I take a consensus of all of you as experts and take the mean or the median and use that as basically the estimate of where interest rates are gonna be in the 10-year treasury for next year? Is that a logical approach? Yeah, that's what the Fed does, okay? In their open market committees. They go around to all the committee members and they ask them questions on where they think inflation and inflation expectations are gonna be. And they form an interest rate consensus. So where do you think the interest rate 10-year treasury is gonna be next year? What?
3%.
3? 3? 2.5?
4.
4? 3.5? Okay, and where's it now? 2? Some of you are saying it's gonna double. It's gonna go up 200 basis points in a year. The market's gonna crash. Okay, so what's the probability of the 10-year treasury going to 4?
Same.
Yeah. So what is the probability that it's gonna go to 3 from 2? That's a 30% increase in long-term interest rates. What's the probability? Probably unlikely. So keep going. You know it's not going to be 2. You know it's not going to be 3 or 4.
2.5.
2.5. 2.2. 3. 1. The last class basically said 2.6. That was the consensus. Okay, so that's what we used. So what we'll do is we'll do the CAPM first. Okay, so now we got the risk-free rate. Excellent. What's the beta for JP Morgan? Look it up. It's on the front page. And go to Yahoo Finance, look it up. And go look it up in the S&P, down to Vantage, Morningstar, Value Line, which were the other sources. Maybe go to NASDAQ. You know, I don't care where you get it. You give me a beta for JP Morgan.
1.06.
So I got 1.06.
1.2.
I got 1.2.
Yeah.
1.06.
1.2.
Where are you getting that?
In front of analytics.
I've got
1.2. I got 1.
1.2. Where'd you get that?
Yahoo Finance.
What does that merchant say?
Margin.
What does it say on the main page of JPO? It gives you the beta. What does it say? What is it? For merchant? It's in the upper right hand corner. Can I Google it?
Yeah.
Yeah.
What does it say? What is it?
I got 1.06.
You got 1.06.
1.21.
I got 1.21. I got 1.06. What is it? 1.2.
I have 1.2.
1.2. The last class used 1.21. And what does that tell you? If the beta is 1.21, what does that tell you about the returns on JP Morgan stock compared to the market? If you got a beta of 1.2, what does that tell you about?
Less risky.
It's what?
Less risky.
How's that work? what's the beta measure?
It says the higher the beta value, the more risk you take as an investor, but the higher your chances are of a big return.
Got it, okay, so if there's more risk, is the return's gonna be higher or lower than the market? Higher. Got it. So if it's 1.2, what's the market? What's the market beta? One. And if the JP Morgan is 1.2, what does that tell you about the returns?
A little higher.
They're gonna be higher, it's gonna move more, right? So there's more risk associated with it. I personally think the beta is actually less than 1.2, but we're gonna use it. The other class said, okay, we'll use 1.2. Now I got the beta. Okay, what else do I need for the calculation for CAPM? What? The return on the market, got it. Can I also use the expected return on the market or the historical return on the market as a discount rate? What? Somebody answer that. What's the answer? A lot of these answers are either yes or no.
Yes.
Okay, yes. So I can basically use the expected return on the market as a discount rate. Excellent. Do you know what the expected return on the, or the historical return on the S&P 500 was over the last 10 years? Or 20?
8%.
Okay, I got 8. Do you know how to calculate the average annual compound growth rate on the S&P 500?
Good.
10%?
Okay, I got 8, I got 10. Anybody else? 10%? So probably between 8 and 10. Where is the S&P 500 trading right now? Where's the index?
2094.
3094. Okay, there it is. Where was it 10 years ago? You probably want to write this down because if you walk into a job and you don't know how to calculate an average annual compound growth rate, they'll probably show you how to do it, but I'm going to show you how to do it now. And I think I showed you how to do it before. I'm so nice, aren't I? Okay, so where was it 10 years ago? Yeah, 2091, something like that.
Yeah, like
So what's 3094 divided by 1091? Do you have your calculators? So what's 3094 divided by 1091? Did you calculate it or did you just read it?
No.
Okay, so yeah, it's like 2.83, 2.84, exactly. And then you want to take it to the 110. And what's 110? 1 divided by 10 is 0.1. Got it. So take the 2.836 to the 0.1. Can you do exponentials? Can you take it to the 0.1? Do you know how to do that? I hope so, because you were doing it all, midterm. What is it? 1.11. Got it. And what's 1.11 divided by minus 1? 0.11. What's 0.11 times 100? 11%. Got it. Okay. So basically, over the last 10 years, the S&P 500 has gone up 11%. Okay. So I basically just plug that. Where did I plug that? Oh, right here. And some of you said 8%, right? Some of you said 10%. So basically, the expected return on the market over the last 10 to 20 years has been between 8 and 11%. Okay, so maybe around 9 or 10. Okay, so there's one discount rate already done. Boom. Got it. So we ended up using 10%. Okay, for the expected return on the market, minus the 2.6 risk-free rate on where we thought the 10-year treasury was going to be next year. We got a market risk premium of 7.4%. We took the 7.4% and multiplied it by the beta of 1.21 to get the market price of risk of 8.95. 8.95. Then we took the 8.95 and added it to the risk-free rate of 2.6 to get the estimated cost of the equity or the expected return on the equity of 11.6%, which I think is kind of high. Okay. So we put the 11.6 over here. And if I rounded it up, it's basically 12. And if I round it down, it's basically 11. Okay. So now I got the CAPM, and I got the expected return on the market. So what's the third method that I could use to come up with a expected return or a discount rate? The other class did it for you, so I'm making it easier on you. Now, Cortland, don't be so shy. I mean, you're going to be a securities attorney in front of a bunch of people trying these security cases in front of these guys from New York. So you can't be like going, it's going to be weighted average cost of capital. So try it.
So weighted average cost of capital.
God, so it's the WACC, okay? So you're going to be, so what's the WACC calculation? How do you calculate the discount rate using the weighted average cost of capital? You guys got to be looking it up, okay? Okay, you got to be looking it up, okay? Okay, this is a participation class. This is total application, okay? And if you guys are disinterested and this is boring, or if I'm wasting your time,
What was your question?
what I would do is just, just leave and then watch the video later, okay? Just don't distract me. On this stuff. I'm trying to get through this stuff. This stuff's really important. So what's the calculation of the weighted average cost of capital?
The market value of the firm's equity over the firm's equity plus the firm's debt, or the market value of the firm's debt times the cost of equity, and then that's added by the market value of the firm's debt over the market value of the firm's equity over the market value of, or plus the market value of the firm's debt, times the cost of debt times 1 minus corporate tax rate.
Excellent. So what's the tax rate for, average tax rate for JP Morgan? And what's the cost of the equity? What are we using to determine the cost of the equity? What are we using for the cost of the equity? Cap M, got it. See, I'm just going to ask the questions over and over again. Different ways to see if you're following along. Okay, so do we have the cost of the equity? Yes, got it. Okay, good answer. Can I get the market value of the equity? Can I estimate the market value of the equity? How do I do it? How do I calculate the market value of the equity? You need to be writing all this stuff down because you don't remember anything. How do I calculate the market value of the equity? You're not going to get the answers out of me. You got to find the answers. What they're going to do is they're going to give you these problems and these projects when you go work somewhere, and they're not going to explain how to do it. They're going to expect you to go figure it out.
Or if you ask.
What?
Or if you ask them.
You could do that too. I'd probably tell you if you asked me. But I want you to figure it out. So how would you calculate the market value of the equity?
Was it the stock price times outstanding shares?
Yes, the stock price times the outstanding shares. How would I get the market value of the debt? Yeah, could I go and look at the bond issues and figure out the price of each bond, right? The price of the bonds times the number of bonds. The price of the bonds times the number of bonds is going to be the market value of the debt. Can I do that? Can I use the book value of the equity?
Yeah.
Yeah, can I use the book value of the debt? Yeah, can I basically take the book value of the equity divided by the book value of the debt and the equity to get the weight of the debt? And then can I just take the weight of the debt minus 1 to get the weight of the equity? Yeah. Okay. So what's the book value for 2018 of the long-term equity and the long-term debt? Where would I go to get that? Where would I get that? Yeah, the financial statements. Which one? That's the source of the data.
The 75.25.
We're going to get the value, the book value of the long-term debt and the owner's equity. What financial statement?
Balance sheet.
Balance sheet.
Yeah, there was a lot of prerequisites in this class. Okay, so I'm just testing you to see if you remember this stuff. Okay, so what's the value of the long-term debt? for 2018? What's the
December
value of the long-term
31st.
debt? What is it?
December 31st, 2018.
Yeah, that's for the year.
282, I guess it's trillion, 031,
What is it?
282,
282 billion?
yeah.
So last class got 296.47.
No,
I got long-term debt right here for JP Morgan,
for JP.
including current portion comprised of blah, 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 whatever.
They get 296.47.
I don't know where that is. I got 282 as well.
Yeah, 282.31.
Did you?
Yeah.
Yeah,
Total long-term debt.
282.31. Your
Is
last
everybody
class.
getting that?
Yeah.
Yeah.
Come on, we're on the merger.
That's for 2018.
We caught him sleeping.
Yep.
Yeah.
Now, that, that's section 3. Okay, what's the book value of the long-term equity? Oh, nobody got me the average tax rate. 19%, okay, got it. What's the value of the long-term equity? Or the owner's equity, sorry. I think it's on one of those main pages in the financial.
Is it a capital stock or?
No, long-term, the equity, owner's equity.
That's stock is equity.
What do you get?
256,515. Oh, that's in millions, so.
What is it? What did you get?
256,
515.
515.
Is that what you guys are getting for owner's equity?
Yeah.
Got it. And what's owner's equity plus the total debt? What do you get?
It's all the way at the bottom.
The total, you know.
So what's owner's equity plus the total long-term debt?
538.
What is it?
538.52.
Is everybody there yet?
Yep.
Okay. And what's how do we do it? We did the debt first. So what's 282 divided by 538? 539.
Plus,
0.52.
So 0.52. What's 0.52 minus 1?
0.47.
So I got the weights. Does everybody follow? Or we got the capital structure? Yeah.
where'd you get the 0.52 again?
We took the book value of the debt, the long-term debt, and divided it by the book value of the long-term debt plus the book value of the owner's equity. So book value of long-term debt plus the book value of the owner's equity gives us a total of 538.52. We took the book value of the debt divided by the book value of the debt, the equity, and we got 0.52. We took 0.52 minus 1, we got 0.48. 0.48. Okay, everybody get it? How we got the weights? Okay. Oh, we didn't calculate the cap member. We did. Is everybody happy with this?
11%. Yeah.
11. So we plugged in right here, I got the weight of the equity. I got the cost of the equity. Oh, shoot. We need to get the cost of the debt. Can you go up in the margin? I think underneath it says long-term debt.
Yeah. No, that's what we just did.
We were just looking at.
282.0.
I'm not looking for the price, I'm looking for the rate.
Oh, the rate.
Yeah, can you go back and you go into the long-term debt? There should be a bunch of debt issuance, some securities that have been issued recently, both fixed and variable, to give us an idea of what their cost of debt is.
Yeah.
Are you talking about the ones that are listed as Series O, Series B?
Yeah, exactly.
So all those?
Yeah.
Okay.
Isn't it going to give you the issues, the debt issues, along with the interest rates and what those bonds were issued at? Can you find it?
Where's that subsection?
I don't know.
It's all under, it's
Well,
all under
that-
total.
There's
Difference
a tab that says
between
long-term debt.
variable and fixed.
Got it, so what are the interest rates on it?
On the fixed rate,
Yeah,
0.17% to 6.40% of December
okay,
31st.
6.4%.
That's fixed.
Okay, what's variable?
And the variable is 0.17 to 6.4, same.
Okay, so 6.4%. So basically what we did was we went in to the long-term debt tab and we looked at the debt issuance. That JP Morgan, the most recent debt issuance that they did, and we looked at what they issued the debt at, what their cost of the debt was, and it was roughly 6.4%. So I can also go out into the marketplace and find JP Morgan bonds that are currently traded in the marketplace with maturities of 7 to 10 years, and calculate the yield maturities and use that as the cost of the debt. So there's two ways of doing it. So the last class used 6.4%. Okay.
Yeah.
So what's the final piece of the puzzle when you're calculating the weighted average cost of the capital, particularly the debt piece? I got the weight, I got the cost of the debt. What else do I do? What else do I do? Okay, let me ask the question again. We're calculating the weighted average cost of capital. We're looking at the debt component. We've got the weight, we got the cost of the debt. What's the next piece that we need to calculate that piece? What are we missing? Can you go up on your computers and look up the weighted average cost of capital and give me the answer?
Corporate,
What is it?
corporate tax rate.
The tax rate, okay, and what was the tax rate? What was the tax rate that you gave me? 19%. So what's 1 minus 9.19?
A1.
0.81. So do the calculations, please. 0.81 times 6.4 times 0.52. What do you get?
0.269.
What is it?
2.695.
I can do it again.
Okay, do it again.
Yeah.
So 2.69, 2.7.
Yeah.
Okay, got it. Excellent. And then we know what the cost of the equity is. 11.6, we know what the weight is. So it's 11.6 times 0.48.
5.56.
What is it?
5.5.
Or
5.6.
5.6. If you look at the descriptions for every class, okay, they give us professors, basically a list of things that you guys need to learn. This is one of them. Okay. Everything that you've learned is all being pulled together now into an application. Okay. So what is 5.6 plus 2.7? Can you guys stop talking because it's really distracting? So what's 5.6 plus 2.7? What is it? Is it?
Yes.
Okay. 8.3 or basically 8. Okay. So basically I have a weighted average cost of capital of 8%. I basically have a range on the expected return on the market for the discount rate of between 8 and 11%. And I basically got a cost of equity of basically 11.6 or 12 or maybe 11. Okay. So which one's going to be the lowest? The WACC, the expected return on the market, or the cost of the equity? Which one's going to be the most expensive? Which one's going to be the highest? CAPM, expected return on the market, or the weighted average cost of capital? Which one's going to be the least? Which one's going to be the lowest?
Yeah.
And we're not using the debt because we don't use the debt as a discount rate or an expected return. We use what? We use the WACC. So which one's going to be the lowest? It's going to be the WACC. And why is it the lowest?
That's cheap.
Because debt's cheaper. And why is debt cheaper than equity? Because that's right. You basically have a tax shield because you can deduct the coupon interest on the debt. Can I deduct the dividends paid on my stock? Can I deduct the dividends? No. Can I deduct the coupon interest? Yes. So what's cheaper, the debt or the equity?
The debt.
Got it. Okay. It's all just fundamentals, it's just rules, stuff like that. You guys need to, you can talk about stuff, but again, it's really distracting, okay? You need to stay focused on this stuff. Because this is it. This is the part of the class that's the most important, okay? Because I'm not gonna go over this stuff again. This is it. And either you get it or you don't, okay? And if you don't get it, then they're gonna expect you to know it, because you went through the program. Right? And if you can't answer the questions in their interviews, you're not getting the job at Bain or McKinsey or some other place that you're gonna want. All right, so now basically we have it. So the WAC's gonna be the least. So we're gonna use 8%. So what's the range on the expected return on the market? 8 to 11. So if I'm gonna use 8 as the starting point for my discount rates, what would I use as the next sensitivity in my discount rate? 9. Got it. So then I would use 9. And what would be the logical next one to use? 10. Okay. So basically you're going to use 8, 9, and 10. What did you use in most of the other examples that we used? On the midterm and stuff. Like 8, 9, and 10. Okay, so that's your sensitivities. That's what you're going to use to conduct the intrinsic valuation, particularly for the perpetuity, the Gordon growth, and the discounted cash flow. Okay, and then we'll do the research to get the multiples. Okay, we're getting there. We'll get there. Nobody said this was going to be easy because when they pay you to do this stuff, they pay you a lot of money. So they're going to expect, they're not going to just pay you a lot of money for no reason. Okay. So we got the discount rates. Excellent. Anything else? I think that does the discount rate determination. Awesome. Okay. Oh, let's go over here really quick for a little sidebar. Can you look up the total assets for the peer group? What's the peer group? Bank of America, Wells Fargo,
Chase.
Citigroup, Goldman Sachs. Can you look up the total assets as of, I don't care if it's at the end of 2019. I like to use the 2018 numbers because it's audited.
For who? JP Morgan?
Yeah, what is it?
No, I just want to,
What's the total assets?
2.6.
2.6, got it, check. Excellent. What about Bank of America?
2.3.
Is that what you're getting? Is it like 2.398 or something?
2.32.
Got it. Wells Fargo? 1.9, because I rounded all these. What about Citigroup? Are you guys looking up the numbers and checking on? 1.9, is that right? And what's Goldman? 900 something, or 886 or something, round up to 900 million. Are these pretty big companies?
Yes.
Yeah. Their total market cap together, 9.7, almost $10 trillion. These top 5 companies own basically 50% of all the assets in the banking system. It's an oligopoly, it's a cartel. Okay. Most powerful financial institutions, they own Washington. Okay. They own it. They're the biggest contributors to political campaigns and PACs in Washington. They basically control policy and finance. They control you. So it's really important. So if you add these up and divide them back, you get the market share, right? You get the percentages. And we're gonna take ROE, ROA, debt to equity, blah blah blah, and we're gonna calculate weighted average financial ratios and use those weighted averages as the pair groups to conduct the financial ratio analysis. Okay, awesome. Okay, now this one was really hard in the last class. A lot of students basically checked out, they freaked out, okay, because they don't know how to calculate percentage changes. Okay? And they can't calculate percentage changes when numbers are negative. So we had to have one person basically export the data out of Mergent and do the calculation, and we had to go through it like 3 or 4 times until we got the calculation correct. So what I need you to do is to pull up, go into Mergent, go into financials, I think it's financials and standardization, is that what it is? Is that
Standardized.
what financials, and you go
Standardized.
standardized, and then you go to
All available.
what, income statement, and then you go to all available, and then you go down to the bottom, and you find earnings per share basic, right, and how far back does it go? How far back does the earnings per share go?
It goes to like 1980.
Yeah, like
1982.
82, you got 82?
Yeah, 82.
82? These guys only gave me 86.
Oh, skaters.
Wait, what are we looking for?
What's our cash flow metric that we're using to do the valuation?
Oh no, it stops at 86.
Stops at 86.
Yeah,
Or
Yeah.
starts at 86.
Starts
It
at
starts.
Yeah,
They have
but-
other info, but
So can you
create
read
a
off,
report, it
can
starts
you
from.
read off the earnings per share? Hold on, you guys, can you start reading off the earnings per share so we can double check to make sure that my, analysts aren't dyslexic or something, and they swap out the, sixes for nines and, fours for eights and stuff like that? Because I have it.
They're right.
Okay, so can you check these and make sure these are correct?
Yeah.
So 2.52, negative 5.56, 4.01, negative 2.76 for 89, 0.79, are you guys following along?
Yeah.
0.04, 1.3, 1.9, 1.55, 2.24, 1.67, 2.77, 2.9, 4.33, 2,000, 2.99, 0.83, 0.81, 3.32, 1.59, 2.43, 4.16, 4.51, 1.41, 2.27, 2010, 3.98, 4.5, 5.22, 4.3. I know this is boring, but you gotta get used to having attention to detail, right? Because they're gonna check your work, and if it's wrong, they're gonna be upset. 5.34, 6.05, 6.24, 6.35, 9.04, 2019. Can you go find me 2019 EPS estimates, or give me the trailing 4 quarter? So what was the earnings per share for the third, second, first, and fourth quarter? Add them up and give me the number. Can I use a trailing 4 quarter as an estimate for the year? Can I use the trailing 4 quarter
Yeah, can you just take the average?
hold on, that's one method. Can I take the trailing 4 quarters of earnings per share and add them up and use it as an estimate? Got it. Can I take the last 3 quarters of earnings per share, add them up and divide it by 3 and multiply them by 4?
Yes.
Yep. Can you do that for me? It doesn't matter what your major or what you're gonna do, you guys are gonna be doing this stuff. Doesn't matter. Sales projections, production, ops, accounting, finance, marketing. So funny, everybody says I want to be a marketing major so that they can do PowerPoint presentations and all this artistic stuff. And then when you become a marketing manager and a managing director of marketing, you're doing sales projections and stuff. So you're doing all the finance stuff. You're just different. You're providing the finance department with the sales projections to get the revenues and the earnings, to project the earnings and the PE multiple to be able to forecast what the stock price is going to be. Because the HR people have to decide what your stock grants and your stock options are going to be. And see if you're going to be in the right. And see if they can price it. Everybody works together. So what's the 2019 estimate of earnings per share that you're going to give me? What's the trailing 4 quarter? Can you go up into Mergent, go into income statement, go into standardized, and basically go back 4 years or 3 years on a quarterly basis? Don't pick annual, pick quarterly, and give me the last 4 quarters. So add up the last 4 quarters, and what do you get? Can you guys look around and make sure everybody's can get me the last 4 quarters of the EPS? Because I got some people that are blanking. How many people are finding the quarterly EPSs? You got it? Can you teach these other people to find it?
Yeah.
What is it?
I got 10.17.
You got 10.17? That's what I got.
Yeah.
We got 10.17. What?
What numbers did you add? I added 2.65.
Margin, top loader, and then pricing information.
I get it there, but I get the income statement.
No.
So you guys should be getting 10.17.
We got 10.89. We're using net basic, right?
Yeah, you can use that. So did you take the 3 divided by 3 times 4?
Yes.
Yeah, that's what we got the 10.89.
Yeah.
And then the trailing 4 quarters, 10.17.
So what do you do for the 10.17? Do you use diluted?
Well, actually, what they did, no, we just took the 10.17 as the trailing 4 quarters. I don't use the diluted, I just use the basic. Okay. And then what the last class did is they basically took a midpoint between this. And I think they took like 10.5, something like that. And what they did, then they take 10.5, what's the percentage change between 10.5 and 9.04? What's the percentage change?
0.84%.
Nope,
Otherwise, 16%?
yeah, it was roughly 16. So they plugged that in. So our estimate, using the trailing 4 quarter, and then using the last 3 quarters divided by 3 multiplied by 4 as a run rate, and then we used the midpoint between the two. And then we calculated the percentage change, and we got a 60% change estimate of earnings per share growth rate for 2019. Okay. Is that a reasonable approach? I mean, could I defend myself in a meeting?
Yes.
Yeah.
That's right.
Yeah. I mean, I could have done like a income statement and basically projected all the line items within the income statement for 2019 and got the earnings and divided it by the estimated shares outstanding to get the earnings per share. Could I have done that? Yeah, I could have done that, but we don't have time to do that. So we're doing it a shortcut way, but we're gonna be close enough. Got it. Now what we gotta do is we gotta be able to project out into the future. And what we wanna do is we wanna go back in time and look at earnings per share growth rates historically and use those as an estimate for future earnings per share. And use the most recent earnings per share growth rates to give us an indicator of where the growth rates are gonna go over the next how many years?
7, 10.
How many years do we need to project out?
3 years?
Okay, what year are we gonna use to do the valuation? 2019 or 20? 20. So that's the first year. So for the discounted cash flow model, I know, this is just grueling.
6 years.
You gotta go out 6 years. Okay. So I gotta be able to project out 6 years. We know what the most recent history of earnings per share growth rates have been. But let's go back in time and look at what historical earnings per share growth rates have been to get an idea of the distribution of earnings per share growth rates under different economic phase scenarios. I'm not an accountant, I'm more of a financial economist, even though I have a degree in accounting. So I like to use either macro approaches, top down, but you can also use the accounting bottom up approach too. Okay? But I'm gonna do the top down because it's faster. Okay? I don't wanna spend a whole class on financial statement analysis. You guys can take it when you double major in accounting. So let's go back in time. All right? So we already have the earnings per share calculations. So can you go ahead and export that and calculate the percentage change per year in earnings per share and verify these numbers? Okay?
Yeah.
It's really hard because remember in finite math, when you take percentage changes of negatives to positives, right? It gets the percentage change calculation gets all whacked out and your brain blows up, okay? And your brain short circuits, right? Because you don't know how to calculate percentage changes from negatives to positives. Okay, it's a whole different type of thing. So can you go ahead? What I usually do is I'll do the calculation, and I know that when it goes from positive to negative, is it going to be positive or negative? If it goes from positive to negative, do I know that the percentage change is going to be positive or negative? Negative. And when it goes from negative to positive, is it going to be positive or negative? Positive. And when it goes from positive to negative, is it going to be negative or positive?
Negative.
So I know basically the direction. It's just the magnitude, okay, based off your finite math class. I guess you guys took that what, your freshman year or something like
Yeah.
that. And you guys don't take TREG except for, or calculus except for the data analytics people take the calculus.
I think it's required now,
What is it?
calculus.
I don't know. All right.
I will never
So
take
can you
that.
verify some of these percentages for me? Can you guys verify these percentage changes for me? Can you go through some of the brain damage that we went through in the last class? Because they basically almost walked out in a riot because they couldn't figure out how to do the calculation.
It's a little hard.
I'll tell you that in a minute. This one,
Yeah.
what we did was we took the midpoint between the trailing fourth quarter, and then we took the last 3 quarters of EPS, added it up, divided it by 3, and then multiplied it by 4 to get a run rate estimate of the earnings per share for 2019. And then we took a midpoint between the two, which I think was 10.5.
The average?
Yeah, we took the average between the two, calculated the percentage change, and got the 16%. Okay?
So previous 3 quarters.
Took the last 3 quarters, divided it by 3,
Okay.
multiplied by 4,
Okay.
to get a run rate for an annual EPS. So we took the trailing fourth quarter, we took a run rate, then we took the midpoint between the two, and then calculated the percentage change between the two. So here's the test question. If the earnings per share was 16% last year, what do you think it's gonna be in 2020? Is it 0? No. Is it negative? No. Is it gonna be 50%? No. Is it gonna be 25? Is it gonna be 5? So you can do process of elimination. If you know what it is, then you know what it is. Okay? If you know what it isn't, you know what it is. So by using deductive reasoning, you can get to a midpoint, you can get to a point, and then you use inductive. Use deductive reasoning, then you use inductive reasoning by using data to adjust that number either up or down on the margin to set it. Okay? Where did you learn inductive and deductive reasoning? Did you learn that in your philosophy class? Yeah, accounting, philosophy.
For the 16%, I added the last 3 quarters. I got 8.17 divided by 3. I got 2.7323 times that by 4. I got 10.89.
Right there.
Oh, I thought you were supposed to get 16.
No, 10.89.
Okay.
And then the trailing fourth quarter was 10.17.
Then you
So
divide that.
we used 10.5. So we took the percentage change between 9.04 and 10.5, and we got 16%. That's how we got the
Wait, what?
You took 10.8.
trailing 4 quarters, 10.17. Took the last 3 quarters, quarter 3, 2, and 1,
Yeah.
added them up, divided by 3, multiplied by 4, we get 10.89. We take the average between the two to get 10.5. We take the percentage change between 9.04 and 10.5, and we get 16%.
Okay.
Okay? All right. That's just one way to do it. Okay, awesome. So just some inductive, deductive reasoning. If the earnings per share growth rate was 16% last year, what do you think it's gonna be next year? 100%? Negative 100%? Plus 50%? Negative 50%? It's gonna be 0? No, it's gonna be 3? 3%? 16%. How big's the company? How big is the company? 2.6 trillion. Do these companies, do they sail like a J-24, or do they sail like a cruise ship? Cruise ship. So it's momentum. So there's earnings momentum. Earnings just doesn't collapse. We're not going into a recession, so it's going to trail off. So it's probably going to be around 16, or probably below 16, right? Because things are starting to slow. Okay? So by just using some of the most recent figures, you can get kind of an estimate of what the projections are going to be, at least for the next 2-3 years. And then you go back and you look at the history. So what the last class did is they went back and they calculated the percentage change in the earnings per share going back to 1986. Okay? And then what we basically did is we said, okay, is it going to be negative 320 over the next 6 years?
No.
No. Negative 172? No. Negative 169? No. Is it going to be 180, 128? No. Negative 94? No. Is it going to be 315? No. 46? No. Negative 18? No. 44? No. Negative 25? No. 66? 4? Maybe. Is it going to be 49? No. Is it going to be negative 31? No. Negative 72? No. Negative 2? No. 309? No. Negative 52? No. 53? No. 71? Nope. 8?
Possible.
Maybe.
Potentially,
It's a low number.
69?
No.
61?
No.
73?
No.
13?
Oh.
Maybe. Isn't it within that confidence interval? 16?
Yeah.
Maybe.
But that's it, but that's
Negative
it.
16? No.
No.
22? 13?
Potentially.
3?
Yes,
2?
yes.
42?
No.
So you basically take the sample of the probable growth rates, and you basically rate them from high to low, and look at the medians, the means. So basically between, a midpoint estimate would be between 13 and 8%. A low estimate, a lower estimate, or a worst case estimate, would be between 2 and 4%. And a best case estimate would be between 13 and 16. So basically we have a distribution and a probability. So then I asked the class, well, what do you think if it was 16% and this is the distribution? Are we going to be in a recession next year?
No.
And it's going to be an election year, and the Fed's lowering interest rates. So are all those positive for the banking industry?
Yes.
Absolutely. And where's unemployment?
Up,
Yeah, exactly. Is that positive?
yes.
And what's job growth doing? It's like 160,000 or an average of 200,000 per month for the last 4 years. So are we going to fall into a recession?
No way.
Are we in the recovery phase right after a recession? No. Are we in growth peak phase?
Yep.
Yep. Are we in the deceleration falling into a recession?
No.
So we're probably going to be what? Probably somewhere in here. This is probably going into the decline phase. This is in probably, growth peak right up here. So now you got basically some ranges. So I basically asked the class, and you tell me if you agree with what they said. I mean, obviously it's easy from a groupthink standpoint to just agree with what somebody else has said, but you're not thinking and you're not getting input. So the last class basically came up with their estimates. You tell me if you agree with them, and if you want to change them, we'll change them. So what do you think the earnings per share growth rate is going to be for 2020, between 19 and 20? Based on the knowledge that you know about the company, based on the analysis that you conducted, based on the most recent period.
Should be closely related with the last period. So.
Yeah, so what do you think it's going to be for 2020? What's your EPS estimate?
10.
Okay, I got 10. What?
13.
I got 13.
I'd say 13.
I got 10, 13. Remember, these guys are just the first out of the box to make an opinion. Most folks will just follow somebody else's lead and not come up with an opinion of their own. Because it's easier to follow other people's opinion, because that's what groupthink is all about. So a lot of these leaders, everybody follows them into the freaking rabbit hole,
It's not,
because they don't have an opinion.
it's not, I've been looking at all the along down the road, it seems to me like eventually it kind of drops off. From it.
Yeah, it's
Like,
gonna slow
like-
down. What's the probability of a recession the further out you go?
Yeah.
More than
Higher or lower?
Higher.
Higher, okay. And when did we say the recession was probably gonna hit?
But would
21.
it,
Yeah,
even
so
though it's
where
an
are we now?
election year, wouldn't it
We're
still?
19. So when do you think the earliest it's gonna hit?
21, 22.
Yeah, probably 21 or 22. Are we gonna be in a recession during the election year?
No.
No? So do things really go back really quickly in 4 months, or does it take another 24 months?
Another
So
24.
probably not even in 21, probably in 22.
But
So
you,
you're probably gonna have 2 really good years in 2020 and 21, right? And then it's gonna taper off. So what do you think earnings per share growth rate's gonna be for 2020?
16.
I got 16, I got
13
10,
actually.
what?
I'll change to 13.
I got 13,
15.
I got 15. I got like 27 people in this class, right? And I only got like a third of the class that's giving me an opinion. Can I basically take a sample? Can I take the 27 opinions and calculate a mean and a median
Yep.
and get consensus estimates on earnings per share growth rates for JP Morgan Chase for 2020? Can I do that? Yeah, that's how the Fed conducts monetary policy, using the Delphi approach. It's the same way we do in business. So I got 13, I got 8, I got 16, anybody else?
15.
15,
14.
14,
12.
I got 12. I got, what? What?
Sorry.
He said 11.
11. So if you take all of those, it's about like 13,
Yeah, let's take 13. That's
13, 13, so you're gonna take it down. I'm gonna get rid of these.
And you can just do like 2%.
I'm gonna get rid of these, we're gonna come up with our own projection. Because I don't think the last ones came up with their own opinions. I think the minority, the people within the group basically convinced the other people to make the decisions, and you guys didn't make it. They didn't make it on a consensus basis. They didn't debate it. So what's the forecast for 2020?
13.
13.
13? So 13%, got it. So how do I calculate the 2020 earnings per share? How do I calculate 2020 earnings per share? I already forecasted what the earnings per share growth rate's gonna be. You already did this on the exam, so you guys should know this.
2019's EPS times 1.13.
Got it, so what is it?
Did you want to use the trailing or?
What did we use? I thought we used 10.5. Well, just give me the, give me 9.04 times 1.16. And what is the 19 estimate?
10.9.
Is that what it came out to be?
Yeah.
Okay. But we don't even need to use that, right? Can we come up with our own 2019 estimate? Are you comfortable with the 16, or do you want to take it down?
Can we take it down?
You want to take it down a little bit? You think it's a little
I think
aggressive?
it's a little too.
Yeah.
I'd say like 14 or 15.
Okay. Well, can I get a consensus?
Yeah. 14 is good.
14?
Yeah.
So we don't have his number.
So how do I come up with the 2019 estimate? How do I calculate the 2019? 9.04 times 1.14, and I get
10.3.
10.3. You guys are gonna be financial economists.
Yeah.
It's gonna take a little bit. So what's 10.3 times 1.13? It doesn't take that long, we only have like 3 more weeks.
11.6.
What is it?
11.63.
Okay, so what do you think the 2021? What's your estimate of earnings per share growth rate?
10%?
Yeah,
10, 12?
even 1%.
I need to hear it. This
11,
side's really
11,
silent.
10.
This
11,
side's like a
12.
talkity group over here.
11,
11,
15.
12, 10,
12,
12,
12 is too
8,
12 to make everybody happy.
15, 15, 11,
12.
12, 15, 10. Are we going into a recession? Where are interest rates going?
They're going up.
Going out, but what is the Fed doing? Lowering interest rates. What's job growth?
Up.
Up. What's GDP gonna do?
Go up.
Probably going up. Are those all positive for bank earnings?
Yes.
So, one more time, what's 2021? 13, 16, 10, 13,
Stick with
13, 13, 15, 14, 13, 14, 13,
That's right, 14.
14, 13,
14.
14, 13, 13.5. It's like an auction house. No, but this is how you do it.
14, 14, 14.
When I'm in a meeting, I'm asking all the analysts and I'm asking all the experts, and we come to a consensus. It's hard to come to consensus, but if you have consensus, everybody's bought in on the estimate and everybody's accountable. Okay, so if it works, we're right, we all benefit. If we're wrong, we all take the hit. Okay. Unfortunately, the government doesn't do it that way. So what's 11.63 times 1.13I?
13.2.
Okay. So now we're getting a little bit further out there. What do you think the 2022?
It's gonna start.
We're going to start decelerating.
12%?
Okay, you got 12,
11.
11,
10.
10, 11,
12,
8, 9, 10,
11.
11.
10, 11, 11, 11. You say 11, I can count you every time you say that. You do like 22
He's helping
times.
eventually, right?
All right. So what's 13.2 times 1.11?
1465.
Are we getting into higher or lower probability of a slowdown in the economy?
Higher.
Higher probability. So what are we gonna do now?
Start decreasing. 9.
To what? I got 9,
Eight.
8,
I'd say 5%. 8.
8,
8.
7,
8's not 5. Not yet.
5.
8.
8,
8's
7,
the consensus.
8,
5.
8. So what's 14.65 times 1.08?
15.8,
What is it?
15.82.
It's going down now.
Yeah, what's the probability we'll be in a recession?
Pretty high.
High.
Yeah, probably pretty high. So what are we gonna do? We're not gonna go negative, we're just gonna take it down.
5%.
4.
4,
5. All
Five.
4.
We still got 2 more
years.
Five.
We can't go
Five,
negative.
4,
5.
5, 4,
5.
5,
5,
Yeah, 5.
We get a 4. We get a 4 in the back.
15.82 times 1.05. What is it? That's not a projection.
It could be.
How much time do we have? Because I want to finish.
15.
Okay, got it. So,
60.61.
what is it?
60.61.
Okay, and what about 2025?
2%.
3.
2,
3.
3,
2.5. 2.5.
3,
Oh,
3,
2.5.
I like 2.5. 2.5. Let's meet halfway.
2.5. So what's 16.61 times 1.025?
17.42.
What is it?
17.03.
Got it. 2026?
0.5. 1.
1. One.
1.75.
So what's 17.03 times 1.08?
1720.
What is it? 1730? What? 20?
Yeah.
1720, okay. That was brutal. So hardcore. Just imagine if you were in the last class. And you guys were freaking out. And it's like, what? Negative 100?
Well, you were.
They were freaking out. They couldn't handle it. It's like some people are just. If I calculate the discounted cash flow, the DCF, and I get an intrinsic value that's 50% higher than the current stock price,
I'd be scared.
is that probable?
No.
So what would I need to do? If I'm getting an intrinsic value on the DCF of like 30 to 40%, what's the probability that JP Morgan stock price can go up 30 to 40% over the next 12 to 24 months? Yeah. So, but I know it's going to go up, but it's not going to go up 30 to 40%, so what would I do? And what would you do?
Wait it, right?
No. We're already going to weight it with the other method. What would I do using the discounted cash flow method? If I'm getting an intrinsic value using the DCF with an intrinsic value that's 30 to 50% higher than the current stock price, the question is, what's the probability of that? 0. So what would I do?
Take your lowest.
What would I do?
Reevaluate your discount rates, maybe?
Maybe.
Take the lowest discount rate?
At 8, 9, 10, that seems pretty reasonable, doesn't it?
Yeah.
For a long-term investor. So it's not in a discount rate, it's in what? If I'm getting significantly higher intrinsic value using the discounted cash flow approach, 30 to 50%, and it's not the discount rate, it's where? Where am I getting the overvaluation? Where's it coming from? Where's it coming from? What is the discounted cash flow approach? Well, it could be in the terminal value, but it's probably in what?
The scenarios, right? So it would be in the weights that you put on the chart?
No. No. I'm saying we're using the discounted cash flow method. And we're getting a significantly high intrinsic value of 30 to 50% higher than the current stock price. Where did we make our mistakes? Where is the overvaluation coming from? You're right. You're right by going back and reevaluating your assumptions. What assumption drives the intrinsic value using the discounted cash flow approach? You guys have done it like 100 freaking times. On your problems, in the extra credit, on the exams. Using the discounted cash flow approach, where would the overvaluation come from? What assumption? Why are you getting a significantly high overvaluation? Isn't terminal value just one component of the discounted cash flow? So where does the overvaluation, controlling for the terminal value, where is the overvaluation coming from? What assumption? Am I asking just an impossible question here? What is the discounted cash flow method? What do you have to do? What's the difference between perpetuity and the Gordon growth model and the multiple model and the discounted cash flow model? What's the difference? How are you coming up with the intrinsic value using the discounted cash flow? Oh my God! Revelation. Where is your overvaluation coming from? Cortland? Your predicted cash flows. And how did you get the predicted cash flows? How did you come up with the predicted cash flows? No?
No?
How did you come up with the predicted cash flows? How did you come up with the predicted cash flows? How did you predict these earnings per share? How did you predict the earnings per share? Did you just pull them out of the air?
From prior year.
How did you do it?
You multiplied the previous year by the percentage change.
And that's called the, isn't that called a growth rate?
Yeah.
Okay, so if your intrinsic value using the discounted cash flow approach, and you're getting a 30 to 50% intrinsic, this is what's gonna happen to you, okay? So you're getting a 30 to 50% overvaluation above the current stock price. What assumption are you overestimating? The growth rate in the cash flows. Bing, got it. Okay, excellent. So what would you need to do? If you're getting an overvaluation in the discounted cash flow of 30 to 50%, what would you need to do? So in the meeting, in front of the board of directors, you're going to tell them that you think JP Morgan stock is basically going to go up 30 to 50% in the next 12 to 24 months.
No.
Because your model said.
Should lower.
You would do what?
Lower.
You would lower the growth rates. Okay. And what do you want to lower the growth rates? What do you want to get to? What's a reasonable premium?
10%.
Yeah, like 10 to maybe 20%. Can JP Morgan stock go up basically 4% per year or 8% per year over the next 2 years? Yeah. So 20% is probably the high mark, 16 is probably a mid mark, 4% per year or 8% premium is reasonable. And it's big enough premium to be able to, when you do the whole weighted averaging, you're going to get basically an intrinsic value that's above the current stock price. Do you think that the intrinsic value for JP Morgan is going to be higher than the current stock price next year, taking into consideration everything we talked about? Yeah. Do you think it's going to be 50 or 30%?
No.
Could it be 20?
No. Oh, I could.
Could.
No way.
Could it be 16?
Yeah.
Could it be 8?
Sure.
Is it going to be 0?
No.
It's going to be negative?
No.
So you know what it is. So if we do this, when we do this, the valuations, if we do the valuations and the intrinsic value, using the DCF model is way too high, you're going to have to go back and you're going to have to take down the growth rates and recalculate the intrinsic value using the DCF because your assumptions of the growth rates were too aggressive. Okay? And there's a warning you know. I've been doing this exercise for 5 years now. Okay, so I did it, what, 10 times for 10 courses, and I see the same mistakes that occur over and over again. Okay, and it's not in the discount rate, it's in the growth rate assumptions, particularly in the DCF. And what model do we weight the most to come up with the final intrinsic value? What model? DCF. Okay. And what's the second one? Multiple. So how do we determine the multiples?
The market
How do we get the multiples?
multipliers.
How do I get the multiple for JP Morgan for next year?
Oh, you take that.
What would I have to do? What's the first thing I would do? What? Yeah, I look at similar firms, and what are the firms? Got it. Okay. What else would I look at? I'd look at other firms that are similar to the company to estimate the multiples. What else would I look at? I'd look at the stock price, and what would I divide the stock price by? Earnings per share, could I use 2018? To get a PE? Could I use 2019? Could I use 2020? Could I use the current stock price divided by 2020 EPS to get an estimated PE? Yeah, I could do that too. Could I look at last year's PE? Could I look at this year's estimated PE? Could I look at next year's projected PE
Yes.
for all the firms plus the JP Morgan and come up with a sensitivity of what the multiple ranges could be? Yeah, exactly, and that's what you're gonna do. So you're gonna have to come to class, next class, for all 5 of the companies. you're gonna have to give me the 2018 PE, gotta give me an estimate of the 2019, and you gotta estimate the 2020. Okay, and then we're gonna look at all those, and then we're gonna set the multiple ranges. We already know what 2020 EPS is, so if we project out what the multiple sensitivities are, we can calculate the intrinsic value of JP Morgan using the multiple approach. If we know what the discount rates and the constant growth rate assumptions are, we can calculate the valuation metric using the Gordon growth model. If we know what the 2020 EPS is, and if we know what the discount rates are, we can calculate the intrinsic value using the perpetuity. And if we know what the earnings per share growth rate projections are going to be in the future for the next 6 years, and we know that the growth rate and the earnings per share are going to probably grow at a constant rate forever from year 7 on, then we can use the Gordon growth model to get the terminal value, to add to the last year's earnings per share in the holding period, to discount back at the discount rates, to basically get the intrinsic valuation sensitivities using the discounted cash flow model. Then we run the 3 scenarios, pick the one in the middle, come up with the total, the weighted average intrinsic value, compare it to the current stock price, calculate the premium, make the buy, hold, sell recommendation, come up with the trade recommendations on the financial services index, financial services ETF, the stock, 12 stock recommendations based on your equity research, both for the proprietary trading unit, both for our clients and for yourself. You can use this methodology to be able to do your own research, to be able to analyze stocks that you're going to invest in to accumulate wealth, so that you can invest $1,000 a month for the next 30 years. And if you get to 8 to 10% annualized rate of return on that $1,000 a month for 30 to 40 years, you're going to be sitting on $3 to $4 million when you retire at 60 years old. Can you live off that? Yeah. $1,000 a month, 8 to 10% rate of return over the next 30 to 40 years, you're going to be sitting on $3 to $4 million. Okay, and that's just from your investments. You're going to probably have real estate. You're going to have other, so you may be able to get to the $4 to $5 million. And then what you're going to do is you're going to invest in real estate, and then when you turn like 70, 80 years old, you're going to take a lot of those assets and you're going to stick them in an irrevocable trust. And you will have bought at least $1 million or $2 million of life insurance, so that when you pass away, the life insurance pays off all the taxes on your assets, pays off all the personal debt, business debt, mortgage debt, and you leave all of your assets to your heirs at a stepped-up basis with 0 tax and 0 debt. They will love you. They will love you. Because you just took care of your kids, your grandkids, and your great-great-grandkids, and your great-great-grandkids.
Thank you.